Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, we welcome Michael Kao. Michael is an investor and has decades of experience. Michael, thanks for joining us today.
So good to meet you, Nick. Great to be
And
with you.
and we just found out that we're actually only a few miles away from each other. We should have done this in person, but next time we'll make it happen.
Sounds
Michael, I want to start with your thesis here that we might be heading into a period of central bank contagion due to competitive devaluations. So let's start with Japan. Japan has a decision: let the Japanese interest rates rise or let its currency fall and weaken versus the dollar. And you believe it's going to let its currency weaken. Walk us through your thesis, please.
Yeah, so a couple of weeks ago, I wrote a post on my Substack entitled "The Battle of the Bads," right? And that is meant to basically take you around the world and kind of put you in the shoes of a lot of the central bankers and the dilemmas that are facing each one. And I'd like to start with Japan because they're probably in the most acute crisis right now because they're obviously experiencing a pickup in inflation finally, but you can see them twist and turn and justify, taking their negative interest rate policy to like a paltry, I don't know, 10 basis points or something like that. So it's not a surprise to me at all that, when push comes to shove and they need to make a decision on whether or not they're going to let JGBs go in terms of letting yields rise significantly in a market determined fashion, or let the yen go, that they would have to choose the yen. And the simple reason, frankly, is that, look, the Bank of Japan owns 54% of all outstanding JGBs, and other essentially private financial institutions, whether it's like insurance companies or banks, essentially own another 40 some odd percent. So I don't see any way for them, short of capital controls, to escape the central bank trilemma that I've written extensively about. And so and frankly, the other reason for why the letting the yen go is the less bad choice is that, look, even though they will undoubtedly import inflation and most acutely commodity based inflation, because commodities are all priced in US dollars, they also are, Japan is a big net goods exporter, as we all know. And so that's one thing that helps them, right? Is a devaluation of the yen makes them that much more competitive on an export basis. But this is where I think each central bank acting in its own best interest can lead to a contagion type of effect, a competitive devaluation, because all of those arguments that I laid out for the Bank of Japan, you can basically rinse and repeat for the PBOC, the ECB, because these are all large exporting regions or export countries. And so, and they have the same issue, not exactly the same. They don't have the dilemma that Japan does, where they can't let yields rise, but they face a similar issue in that, let's take China for instance. I consider China to be the big Kahuna. China's economy is in shambles. In fact, yesterday I posted a bunch of charts from my friends Nick Glinsman and Harold Malmgren, as well as Lakshmi Srikumar at Capital One, all showing various facets of how bad the Chinese economy is still. I call it the China no reopening 3.0. It just doesn't seem like they are able to get out of this combination of secular structural decline as a result of a combination of, demographic decline is like a much slower moving process, but they're caught in this issue where 70% of household wealth in China is tied up in real estate. And for years, you had a lot of Chinese middle class families owning 2, 3, 4 homes. And now, maybe about a year and a half ago, I think the Chinese Communist Party basically issued its 3 red lines policy, saying houses are not for speculation; they're for living in. Right. So they recognize that there's been all this capital misallocation to the real estate sector, but the problem is that if the PBOC doesn't reflate the real estate market, how do you build a consumer-driven economy with any sort of confidence when a huge chunk of their net worths have been decimated? And then B, if you're doing top-down GDP targeting with like a 5% goal in mind, if it's not going to be in real estate because simply they can't, they've already got like 100 million empty homes. What are you going to do? Well, we have an idea of what they're going to do. They've already been refocusing their manufacturing juggernaut to the green energy space. And as you can tell from Janet Yellen's recent visit, that sector is about to get targeted. So all of which is to say that the Chinese government and Chinese economy is facing a myriad of different headwinds, and a devaluation might not help them even, but I can tell you that a competitive devaluation of all of their neighbors, whether you're looking at the Japanese yen, the Korean won, the Indian rupee, they're all devaluing against the dollar. And so the yuan is way too strong vis-a-vis all of its export competitors. And so that now leads us to the Eurozone, right? And so obviously another big competitor for China is Germany from an export standpoint. Well, the European dilemma is slightly different too, but it amounts to the same decision tree, because the European dilemma comes from the fact that the transmission mechanism of tighter monetary policy has hit the Eurozone economy far harder than it's hit the United States. It really hasn't hit the United States, as you can tell from where all risk assets are, and just the signs of resurgent inflation and still very, very well behaved unemployment. So we've got this big economic divergence, and Germany's in deep recession. Germany's being deindustrialized.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today, or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today.
So now we get to the ECB's conundrum, which also is a little bit different than China's, a little bit different than Japan's, but the net result is the same, which is that the European economy is diverging from the U.S. economy. Right, the U.S. alone in major world economies has been spending a lot of money. Last year, I wrote another thread called "The Four Horsemen of U.S. Economic Resilience" that detailed, various factors, including secular demographic factors, the fiscal spending here. The energy independence, and also the relative lack of rate sensitivity on both consumer and corporate fronts in the US. Well, not so for Europe. And Europe's largest economy, Germany in particular, is getting hit hard by a combination of just deindustrializing trends and much slower growth. In other words, the transmission of tighter monetary policy through a stronger dollar has disproportionately hit the European economy. And so I think that as much as Lagarde would like to follow the Fed, and historically that's exactly what they've done, I think this time they're going to have a hard time doing that. I think the ECB likely will have to cut multiple times this year, but not so for the US, right? And so when you take all of these central banks acting on their own behest, right, in terms of selecting the most optimal choice, it always comes down to, in my opinion, they will have to adopt policies that will lead to a competitive devaluation, a devaluation of their currencies against the dollar. And so take each one taken separately is not a big deal. But when you look at what that then does, you see a sort of beggar thy neighbor type of dynamic where, every world economy is needing to kind of jostle for competitive exports, essentially. And that's what can cause a contagion. And I think, when I look at, I trade this stuff pretty actively and I watch. And, one telltale sign of how desperate the PBOC is that they have jacked up the overnight HIBOR rates to make it very, very expensive for speculators like me to basically be short the yuan. And historically, they are obviously doing this to prevent a disorderly devaluation. China, in particular, is I think, should be a worry for every macro watcher out there, because last March I wrote a piece called "A Ball in a China Shop," meaning the U.S. dollar wrecking ball in China. How while the world at that point was just focused on more provincial worries of the Silicon Valley banking crisis, I said then over a year ago that the thing to watch is that if China is forced to devalue the yuan, they will export a large deflationary pulse to the world. And when you look at it that way, right, there's good and bad to it, right? The bad is that in an uncontrolled fashion, you could have a currency crisis lead to a credit contagion like we saw during Asian Contagion 1.0 in 1997 to 1998, right? To just recall briefly what happened there. There you saw a number of the sort of Asian tiger economies who were very, very dependent on dollar-based debt financing. This was the Asian miracle of the early to mid 90s. Well, they started the Thai baht was the first to devalue in the summer of 97. And then it literally led to a cascade all around Southeast Asia. And it culminated in spectacular fashion when Russia wound up defaulting on its GKOs, its government debt, by the end of 98. And then obviously that then led to all sorts of contagion effects in the credit markets. And it led to the blow up and bailout of LTCM. Not saying that necessarily happens this time, but that is definitely one pathway, right? The other more benign pathway is the sort of the negative feedback loop pathway. Because if you think about it, right, what do I mean by the negative feedback loop? Well, if you think about it, the crux of the issue here is that the US has an inflation problem that's largely the result of a lot of spending, okay? I tweeted out this morning, I said, the problem that we're seeing here is that because of all of this spending in the US, it is making it impossible for the Fed to do its job and get inflation back down to the 2% target. And if they actually make the Arthur Burns mistake of cutting here, if they actually cut and inflation is still, super core is still, 3.5 or 3.8, I can't remember what it was, but we're nowhere near their target. And if they cut into this, the bond market will do their job for them. I think you will see a severe bear steepener if that happens. Like, that's akin to what happened at the end of the 79 to 82 Fed policy cycle. So if that happens, right, the crux of the issue, as I was saying, is that we have an inflation problem here spurred by spending. But what we are effectively going to do is, through the strong dollar, is we're going to export our inflation to the world. But unfortunately for the rest of the world, we're not necessarily exporting our growth, right? And so the rest of the world, especially China, which is already facing all these this myriad of economic problems, is going to wind up exporting its deflation to us and to the rest of the world. So that's what I mean by a negative feedback loop, right? Negative feedback loops are self-correcting mechanisms, and in a way, that's the silver lining behind this, right? That's the equilibrating. A strong dollar is the equilibrating mechanism to export our inflation and to import China's deflation.
So, what you're talking about with regard to China exporting deflation stems from a potential Chinese devaluation of its currency, making Chinese goods cheaper to the rest of the world. That forces other countries to then compete and try to devalue. You mentioned Europe or Germany itself as an exporting competitor to China. Then Europe will need a weaker currency. Europe might have to cut rates. So this is the contagion that Michael's talking about. We're going to break it down one step at a time. And we should mention right away, Michael, you have been listening to the most recent Russell Napier interview with Jack Farley, as have I, more than once, because of how interesting it is to do the thought experiment on how and when China might devalue its currency. So my next question for you comes back to this idea that China has to not allow its real estate market to crash, because if it allows its real estate
Well,
market
it's too late for that.
Okay. So it wants to protect against it wants to protect its consumer, because the consumer is the only way out for China in terms of leaving its export driven economy. It needs a strong consumer. But if it can't get the strong consumer with crashing real estate and with the general tendency of Chinese people to save rather than spend, they need to go back to export driven economy. And so your first domino is Japan here. Is the next domino then China as an explicit reaction to Japanese goods being cheapened, or is it more to do with what's going on in the Chinese economy itself, what's going on with the Chinese current account?
Well, so I had a online Twitter debate with Brad Setzer the other day, and I was basically pointing out the yen yuan relationship, right? And given the extreme weakness in the yen, does this not put additional pressure on the yuan? And he was arguing that, Japan and China don't actually necessarily have that much export overlap. Said, okay, well then how about Korea? Because Korea is another big, and it's the same thing. The Korean won has devalued sharply against the dollar and against the yuan, right? And then, okay, if you want to make some sort of counter argument there, then look at the euro. It's all the same thing, right? So, like I said earlier in my preamble about China, China is facing such a myriad of different headwinds that it's not even clear to me that a devaluation will help them, because there's also this geopolitical angle of reshoring, friendshoring, especially after Russia, Ukraine, and the worries over a potential kinetic escalation with China. Just this morning, I was on a private conference call just talking about the Taiwan China dynamic, and so that complicates things, right? So even a devaluation there might not help. And then of course we have the U.S. elections coming up, right? So obviously everybody knows that if Trump prevails, right, his whole one of his key platforms is being very, very strong against China from a tariff perspective. But yes, I can acquiesce to the point that, okay, devaluation might not help them, but I'll throw it back and say that a strong yuan certainly will not help. They need all the help they can get to kind of try to revive their economy. And the one thing I will say with evaluating China from a pure a Western economic rationality lens is that, and I wrote about this in Battle of the Bads. I said that, look, it's tricky because at the end of the day, what President Xi is much more cut from the cloth of Mao than Deng Xiaoping. Okay. And because of that, 2 years ago, I read the biography of Mao Zedong and Chiang Kai-shek back to back to kind of understand the kind of the differences in economic development ultimately between Taiwan and China. And what's scary to me is I see a lot of what Xi's policies. I see a lot of Xi's policies as very, very similar to Mao. In other words, he's not averse to putting the population through economic hardship and extreme austerity. So that's a caveat against them doing what we Western macro watchers think might be the rational thing to do, right? So that would be a reason for maybe them not devaluing and them just saying, you know what, fine, we don't care, but then I'll do the counter to the counter and just say that when we were looking at the China reopening trade 2.0, let's say, coming out of second time around, you did see that with I think it was around the time of the Omicron variant, you started getting social unrest in China with all of their continued lockdowns when the rest of the world was already opened up. And that was a very important tell that even to someone like Xi, who is very Maoist in his outlook, he had a line where he wouldn't cross, where to assuage the masses, he had to kind of acquiesce on his like zero COVID, lockdown policy. So that to me is a sign that at the end of the day, if it's getting to the point where there's social upheaval and unrest, he will do the quote economically rational thing to do. So, yeah. So China, I think, is the big kahuna to watch because, especially with upcoming trade wars being accentuated, I think a pretty severe devaluation could be in the cards. But again, they kind of need to do it economically, but they need to do it in a controlled burn fashion because the scary thing there is that there's already so much pressure for capital flight. Earlier this week, I met an entrepreneur from Shanghai, and I was just trying to take his temperature on, what the mood was on the ground. And still, this is like years after COVID already. He said that it's very, very bad. And it's not just from all the stuff that we read about in the press about their real estate markets. It's the capricious nature. It's the capricious policy of the Chinese Communist Party, where he gave me an example of how he had a friend another entrepreneur who was in a specific vertical. He spent 9 years building this business in a specific vertical. I'm not going to say it, but overnight, literally overnight, the Chinese Communist Party decided that that particular vertical was going to be illegal. His business just went away, just like that. Boom. There's no sort of legal process. It just makes these capricious decisions. So not only do you have this crisis of confidence and the destruction of consumer wallets, the entrepreneurs are scared because their businesses could literally disappear overnight because of the capricious nature of the Chinese Communist Party policies.
And we hear Napier talk about how he believes the terminal value of all Chinese equities is eventually zero. And that does dovetail a little bit with what Michael is talking about with some of these Chinese entrepreneurs. I wonder about the contagion of what happens after a Chinese devaluation. You mentioned exporting deflation as one of the impacts. You mentioned then Europe potentially having to cut rates and drive down the euro to keep Germany competitive. But then let's think about the United States now. Let's bring it back to the US. We have a very robust and resilient economy that has tailwinds from fiscal deficits. It has also tailwinds from just being the most dynamic economy in the world relative to what's going on abroad. So, what does the competitive devaluation abroad come back and affect the US and send it into a recession if we get some sort of broad deflationary wave around the world? How do you think about that? Because I know right now, currently, you're actually short treasuries looking for rates to keep going up or stay higher in this really relative strength of the United States. So will it come back home? Will it send treasury yields
It
lower
can.
eventually?
It definitely can, right? Because I think that that scenario of China exporting its deflation and causing a recessionary outcome here, that's definitely feasible, right? Because you could see it especially in specific industries, right? I call the green tech vertical the Gretaverse. So if the Gretaverse, here's another way of thinking about China. After decades of like top-down GDP targeting, if you picture this, I kind of think of the almost like a comical cartoon where you're on this assembly line. China's got this assembly line, and this assembly line is just like moving goods out in rapid fashion, and it cannot stop. No matter what, it just cannot stop. And for a while, the widgets were basically homes. Homes just churning out. Now they've got like 100 million, empty homes. Where are they going to, continue to get like 5%, GDP growth? Okay, now it's the Gretaverse. Churn. Cheap windmills, cheap, solar cells, cheap whatever. So all right, so they're going to destroy that vertical. Then what, right? But on a macro level, there will be certain sectors that'll get hit harder, right? But on a macro level, if you think about it, the United States is still a net importing country. so it's this is where I think about feedback loops a lot, and this is where, yes, it could definitely cause a deflationary pulse in a recession, but on the other hand, a strong dollar actually solves a number of problems in the world, right? It's an equilibrating mechanism. I can't emphasize that point enough. It's an equilibrating mechanism because China essentially needs to export its deflation to the world. We have an inflation problem that needs curing. We could use a little bit of deflation, and probably it might take a recession to cure our inflation problem. That's how markets work. Ultimately, there are self-corrective mechanisms, and I see that as the primary equilibrating mechanism is the strong dollar.
So the dollar goes stronger off of relatively high interest rates remaining high as the world cuts and experiences either an impulse to devalue its currency or a reaction to a weak economy and needing to cut rates itself to stimulate demand. So those are the factors that drive a strong dollar. Now you have a strong dollar and you have high interest rates. Now talk about US interest rates now. Back to my world. Where do you see yields trading throughout this year? And just mention that you are short treasuries right now.
Yeah, I mean,
What's the time horizon on that trade?
yeah, so I'm short. I have fairly short a short tenor on my puts, and my trade, and right now I'm actually almost delta neutral. I actually covered some deltas and on this recent bear steepening move, so I can I'm nimble in both directions on it, but ultimately, yeah, if we get the recession, you don't want to be short treasuries, right? But the trade that I see here in the shorter term is that ever since this December pivot, I call it the December rhetorical pivot. I think the Fed really screwed up here and essentially got the world thinking that it was unserious in its inflation fight. And if you go back, I like to go back to that 79 to 82 cycle and study history a little bit. So like what happened then was from in 79, 80, and 81, at the I took data points at the beginning of each year and I looked at the yield curve. You basically saw the Fed undertake pretty aggressive Fed hikes. And then you would see, after a couple of months, you would see the long end bear steepen, right? As it perceived that inflation wasn't really under control. But the really interesting thing came by the end of 81, beginning of 82. You then saw the Fed, the U.S. economy go into a recession that prompted a drastic Fed bout of Fed cuts before they cured the inflation problem. And that's the pernicious thing about stagflation, right? You could have a nasty recession and still not have cured the inflation issue. So in that case, we saw a huge steepening in the yield curve, even much more so than the bear steepener. You had a very vicious bull steepener. So I think that there are my treasury short in the short term had to do more with the December rhetorical pivot, and I just think that the yield curve is still too inverted. But the question is whether or not we are in this stagflationary environment, and whether or not the Fed is going to exacerbate things by wanting to ease policy before the fight is over. And so from that perspective, the Fed's best friend is a round of competitive devaluations around the world, and China exporting some of its deflation here.
So if that is the best case scenario, or let's not say best case scenario, but let's say that is a desirable outcome for Powell, that he would be biased to keep rates higher, to keep that dollar strong, to try to import some of the deflation from China. So do you think he's playing that level of 3D chess, or no?
Okay, so funny that you say that, because right around the December rhetorical pivot, right, I was so perplexed by why, up until that point, we had a very strong message from Powell that we need to get inflation down to 2%. Inflation is the most regressive tax of all. The Fed's credibility is on the line. Blah 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 blah. All of a sudden, he waxes very, very dovish on that, and I just could not figure it out. And so I put out this tweet. I said, "This is my Machiavelli J. Powell thesis." I said because especially with the shuffling of the roster in the Fed, right? You've had a couple of notable hawks like Kashgari, leave, and you've had a more dovish complexion in terms of like the current makeup of the FOMC. And I said, wouldn't it be funny if Jay Powell actually did this in a Machiavellian way of setting his fellow doves, whoever put those, like, three cuts in the December SEP. Wouldn't it be funny if he actually waxed dovishly so that he knew you would have this huge risk on, and a resurgence of inflation right as we're coming up to the critical June FOMC meeting? And it's interesting because I don't know, you can't. It's hard to prove that, right? It's kind of it was kind of a tongue-in-cheek conspiracy theory, but I find it interesting that seems to be what's happening now, right? That now whoever has been super dovish on the Fed, everybody is going to be forced to walk back their statements now. And the reason why the June FOMC is particularly critical is that, in case you haven't noticed, we have an upcoming election, coming up, and a particularly divisive one. And so I don't think the Fed wants to be involved and be perceived as partisan in any way, right? So I wrote, I think in a previous Substack post, that I call it, you think about activation energy as a mental model, right? The activation energy to overcome to actually institute not just one. Remember, when the Fed cuts, it's not just necessarily a one and done. When it cuts, it's usually signaling a real pivot in policy. So I think of it as, okay, if it's cutting, it's signaling to the market at least another two or three to follow, right? Between the inappropriateness of that signal and the fact that we have an election coming up right around the corner, I think the activation energy required for the Fed to actually initiate cuts by June is extremely high, especially with all of the economic data and the inflation data that we've seen in the last month or so.
And
So maybe Machiavelli Powell lives.
When I look at the way that the data has played out, it now appears to be impossible for them to cut rates in June, just given where we are and given the recent rhetoric that, Powell this week said, yeah, we're clearly not done yet on inflation fighting, and we have to keep rates here for the time being. So it is very difficult to see them cutting in June, which means any potential cut will be much closer to the election. So now let's get the conspiracy hats on.
And think of the shit show that would cause, right?
Yeah.
I mean, if you wound up like cutting right before the election,
right?
Like you're just gonna, it's just a total can of worms that I don't think the Fed wants to be involved in.
And that's why I want you to put your conspiracy hat on for a second. There's a lot of speculation on the Fed wants the incumbent party to win, or the Fed doesn't want to be involved in politics at all, so it'll cut in June instead of September. And then there's also the Yellen camp, that Yellen is focused on the incumbent winning, so Yellen will make sure to increase bill supply relative to coupon supply to prevent. So let's talk about that. Let's talk about the election. What is the driver? Let's start with Yellen.
Yeah. All right. So look, Yellen is a member of the cabinet. So of course she's a political animal, right? Her job depends on it. So I fully expect her to I often use the vodka Red Bull mental model of Powell and Yellen being like, dueling mixologists, right? Except here the cocktail is our economic cocktail, and Yellen is basically adding the Red Bull stimulus, while Powell is basically adding the vodka depressant. And Yellen keeps adding a little bit more Red Bull, and then it's like, oh, it's too much Red Bull. Then you've got like mixologist Powell having to like compensate. So in the end, you're going to get a very bad cocktail. Okay, that's the lesson of that mental model. So I expect Yellen to be political. But she's a member of the cabinet. It's natural. The chairman of the FOMC is not a member of the cabinet. If anybody should be apolitical, it ought to be a Jay Powell. He's independently wealthy, right? He's and up until the December rhetorical pivot, I'd say that he's done a decent job. I mean, I'm gonna, well, team transitory, and buying like 140 mortgage 140 billion mortgage backs every month back in 2021, even after the vaccine, that never made sense to me. But as far as his inflation fight up until the December rhetorical pivot, he's done the right thing, and he's actually steered monetary policy appropriately, I would say. That's why I was so puzzled by that rhetorical pivot, and I wrote about this at length. It was a terrible risk reward trade for the Fed because they jawboned risk assets and commodities higher without any tangible benefit to the government. They didn't actually pivot. We didn't actually save. Our government didn't actually save in interest expense. So why did they do that? So maybe it is Machiavelli Powell trying to like teach his fellow doves a lesson and basically say, okay, you know what? If I'm right about June or bust because of election dynamics, maybe the idea behind Machiavelli Powell was to goose things up to the point where, okay, by June, all right, see, we can't do anything. So that means no cuts for the rest of the year.
And do you think that is that your base case now? No cuts for the rest of the year, or
I don't see
no
I
cuts
don't see how I don't see how they can do it. Here's another thing to throw at you, right? Here's a concern of mine, and this is another reason why I have a TLT hedge on, which is if you're in Powell's shoes, right? He's done a decent job, right? He's taken 9% CPI down to like a 3 handle. He hasn't broken anything yet. Unemployment is still below 4%. And oh, by the way, Trump has said publicly that he would, eviscerate him if he takes office. So if I'm Powell, maybe I just watch the election, and if Trump gets elected, I just kind of retire early and say, fuck it, I don't want to deal with it, or even announce an early retirement now. Even the reason why I think that's a danger is because, again, the makeup of the FOMC has become more dovish over time, and God forbid if he gets replaced by someone who like a Brainerd, who is known to be much more political. That's where you can see inflation become really, really unhinged. And I would argue that the problem with the extreme problem with this December rhetorical pivot is that inflation. I posted a thing the other day that said that basically inflation has, I think core CPI has trended above 3% for 36 months in a row already. If that's not embedding inflation expectations into the zeitgeist, I don't know what is. And that's a big problem. If there's any hint that they're going to move the goalpost from 2% to 3%, you're going to see the long end absolutely get crushed. I really believe that. Because if the bond market is going to tell the Fed, if you don't do your job, I am going to do it for you. And that's exactly what happened at the end of 81, beginning of 82.
Lots to continue to watch across the global macroeconomic scene. Michael Kao, we are very appreciative of your time. We're going to continue reading your work at Urban Cowboy. Please give people where they can find your great research, your Substack, and your profile on Twitter.
Oh, thank you. I'm Urban Cowboy with a KAO on Twitter, and urbancowboy.com is my Substack. I really
Excellent.
appreciate you having me.
Of course. Michael Kao, I'm Nick Bhatia. Thanks for catching us this time at the Bitcoin Layer, and we'll see you next time.
Great.
Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel, subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.